Now, mechanisms for early retirement of bonds. So when we say early retirement, that implies that we want to retire the bonds prior to their maturity date. So bonds we know can have certain bonds can have very long maturities, but business and economic conditions might warrant that certain bonds be retired early. So at that time, there are always mechanisms which are provided which enable early retirement of fixed income or bonds. Now, a few popular techniques which are used by market participants for exercising early retirement on bonds. One is an issuer call option. So, an issuer call option is an option which is with the bond issuer, such that they have the right but no obligation to call back the bonds either in entirety or in part at a certain price and at a certain specific time in the future. So this is like a definition for issuer call option. Now, what the call schedule is, that will be clearly defined as a part of the bond prospectus. So that way there is no uncertainty as such. The investors at the time of purchasing the bond exactly know that this type of a bond has a call feature, and and the issuer can call back the bond if they deem fit. Now, as a part, if you observe this call schedule, we'll typically observe that the call price will decrease over the life of the bond. Now, a few issues may have a lock-in feature. So when we say a lock-in feature, we can imagine this is like a lockout period for the issuer. So we had studied the idea of lockout periods when we studied from a hedge funds perspective when we spoke of fund management, but that was from an investor point of view. But this lock-in feature is from an issuer point of view. That is, the issuer will not be allowed to call back the bond for a specific time period, maybe for the first few years. Before that, early call option kicks in. Also, this option is valuable for an issuer who wants to take advantage of falling interest rates environment, because in a falling rates environment, what will happen is the issuer might find it beneficial to retire the existing bonds which could have been issued at a higher yield and then reissue bonds at a lower yield. Now that is going to bring down their overall cost, isn't it? Because let's say the current bonds were issued when the yield, or maybe when the yields were around 3%. Just imagine hypothetically. Now, let's say the yields have dropped and now the yield is 1%. Now, the issuer will always find it beneficial to call back the 3% bond and then reissue fresh bonds at the going yield of 1%. Because that way they save on their funding costs, isn't it? They're saving on 2% straight away, 3% for the earlier bond, which they recall, and now issuing a fresh bond at 1%. So the benefit of 2% is something which the issuer would want to capture, because that is going to have a positive impact on their cost of capital. That is going to bring down their cost of capital, which will finally enhance their enterprise value. So in such a falling interest rate scenario, an issuer would always find it beneficial to exercise the call option. Now, if we compare it price wise, then the price for a callable bond will always be lower than the price for a plain vanilla or a non-callable bond. The reason behind that is the option exists with the issuer, and for that, the issuer has to pay a certain premium. So, this is the way of looking at that premium. Now, since the issuer is holding the option, it's making like a premium payment to the investors, and that premium gets translated in the form of a lower price, which can be procured for a callable bond. So, we'll always observe that the price for a callable bond is lower than the price of an equivalent plain vanilla bond. Now, the idea of a make whole call provision. Now, in this, the call price is calculated as the present value of the bond's remaining cash flows subject to a certain floor price that equals the par value of the bond. So, more like a definition for this make whole provision. Now, what should be the correct discount rate? So, the discount rate used to calculate the PV is the yield on a treasury security, which we also call as a proxy for RFR, plus a contractually specified make whole call provision. Now, this contractually specified implies that this will be there as a part of your bond offering or as a part of your offering prospectus. So, it will be clearly mentioned at that time. So, let's try to understand this mechanism of make whole call provision through a simple example. So, let's say on 1st December 2020, Stellar Inc. has issued $1 million worth of bonds and the coupon is 3.5%. And they have a maturity date which is 10 years away. So, it is 1st of December 2030. Now, let's say now these are points which are specific to this particular issue. So we assume that the notes are redeemable at any point in time, either in whole or in part at the issuer's choice. The redemption price, this is defined in two ways. So it could either be the maximum of 100% of the principal amount plus the accrued interest, or a make whole redemption price that is equal to the present value of the remaining coupons and the principal, that is the remaining cash flows on this particular bond, that is discounted at the rate of treasury plus 20 bips. So we observe this spread of 20 bips. This is something which we should look at carefully. So this 20 bips is what we call as a make whole call premium. And this is how make whole call premium gets used in the calculation. And now next mechanism is a sinking fund provision. So in this approach, the corporate issuer must retire a certain quantum or a certain portion of the bond issue each year. So that's like a requirement from the issuer. Now, a few advantages or benefits of this approach is the default risk of the issuer is naturally expected to decrease over a period of time. That is because since the issuer is retiring a certain portion of the bonds, that means their obligation to meet the cash flows on those bonds vanishes. So that way, the potential default risk in the coming years comes down. Also, if the bond price drops owing to an upward movement in interest rates, the issuer may provide some kind of a price support. Why we say price support? Because the issuer uh, will be expected to tap the open market in order to purchase the bonds in order to meet the sinking fund provisions. So that way they can provide a certain price support. So this can be considered as a benefit for this sinking fund provision. Now, a drawback for investors could be the bonds may be called at a special sinking fund call price. And this can happen at a time when the interest rates are lower and the prevailing interest rates at issuance were comparatively higher. So that way, the problem is if the bonds are redeemed or if the bonds are retired, that means investors have to tackle the lower yield environment. So something which they may find difficult because they are going to lose their interest income or yield income. So that is considered as a drawback for investors. The next early retirement mechanism is what we call as M&R, or maintenance and replacement funds. Now, this idea was first introduced as a part of bond indentures for electric utility companies. Now, the philosophy behind the M&R bonds as to why this particular mechanism was introduced. Now, any property or asset which you look at is subject to the idea of depreciation. When I say depreciation, we are talking of economic depreciation of that particular asset. The idea of this fund is that the replacement fund is going to help maintain the integrity of the property which is securing the bonds. That is, whatever property is backing these bonds, that remains secure and its integrity is maintained. That is something which the M&R provision maintains. So that way, there is some kind of a similarity between the idea or the logic of a sinking fund provision and the M&R scheme. However, there is one key difference which you will observe. Again, important from the examination point of view. The maintenance and replacement fund only helps to maintain the value of the security which is backing the bond, because that's its sole purpose. So even if we see the definition, that says the same thing, and even the word maintenance. The idea of M&R is to maintain the value of a security backing the bond, whereas for a sinking fund provision, the idea is to improve the security which is backing the debt. So remember this key difference, again, very important from the exam point of view. There can be a question which can relate M&R with sinking fund provision. So at that time, having a clear idea as to which scheme is there to maintain the value of the security and which is there to improve the value of security should be very, very clear. Then you have a tender offer. So a tender offer is the one whereby the company announces a scheme, or what we call the tender offer, to buy back a certain portion of the issuance. And generally, the size of the tender offer is lower than the amount of outstanding principal for bonds. Now, the idea is the firm sends out an offer circular, and that will be to the bondholders on the and that basically talks about the price at which the firm is willing to purchase back the bond. So this is something which is offered to bondholders in case they want to retire their bonds early. So they get a chance to go through that circular, also get to know the price at which the company will repurchase the bonds from them. And if they deem fit, then the bondholders can accept the tender offer, and they can retire their bonds early to the company so that the company can redeem their bonds. So this is how a tender offer scheme works. So these are a few mechanisms for early retirements of bonds.